Welcome to the Market Updates. Today, we're diving deep into the great divide that's splitting the global markets right down the middle. It's this massive tug of war between what investors are hoping for and what the economy is actually telling us. Right now, the financial world feels like it's stuck at a crossroads. On one side, you've got this incredible hope for big interest rate cuts to keep the party going. But on the other side, you have some really stubborn economic data that's screaming, hey, the fight against inflation isn't over yet. And that clash, well, it's creating a perfect storm for some serious volatility.
So first, let's just quickly look at the global headwinds. And while there are always geopolitical risks out there, the market's attention has really sharpened its focus onto one single entity, the U.S. Federal Reserve.
So what is the Fed's next move? I mean, all eyes are glued to their upcoming Jackson Hole meeting because, let's be honest, it's the single biggest thing driving the market right now. Everybody is on the edge of their seat trying to guess what happens next.
And this right here, this is the question everything hangs on. That huge rally we've seen across stocks, gold, you name it. It's all built on one simple bet, that the Fed is going to cut rates and cut them aggressively. But will they actually do it?
And here's where that massive disconnect just smacks you in the face. On one hand, you have the market, which is pricing in these really aggressive rate cuts. We're talking 100 to 150 basis points. That's a full 1 to 1.5% cut. But then you look at the other side, at the actual economic data, and it's telling a completely different story. And this is the number that's causing all the trouble, 3.1%. This is the latest reading for core PCE, which, is the Fed's favorite way to measure inflation. And not only is it higher than anyone expected, it's actually trending up in the wrong direction. This one number is a huge roadblock for those rate cuts the market is betting the farm on.
So the main takeaway here is pretty clear, right? You should fully expect Fed Chair Powell to point directly at this inflation number. He's almost certainly going to use his big speech at Jackson Hole to pour some cold water on all this optimism and push back against the idea of deep cuts this year.
Okay, so let's pivot to U.S. stocks, because this is where all that hope and optimism might be creating a bubble that's getting a little dangerous.
This hope for cheaper money, it's like that old saying, a rising tide lifts all boats. It's pushing up the S&P 500 and the Nasdaq, and that enthusiasm is spilling over into everything from precious metals to even riskier stuff like crypto. The main thing to get here is that this rally is built almost entirely on hope, not on the current reality.
And the big institutions, they're starting to sound the alarm. Bank of America just put out a really stark warning. They're saying plain and simple, stocks are overvalued. They think the market has gotten way ahead of itself and that we could be setting ourselves up for a pretty painful correction if the Fed doesn't deliver what the market wants.
But this is where the great divide gets really fascinating. While some of these big banks see a ton of risk in stocks, others are looking at the exact same data, the uncertainty, the stubborn inflation, and they're seeing a massive opportunity in gold.
And here it is, the direct counterargument. While Bank of America is waving caution flags about stocks, you've got another heavy hitter, UBS, putting out these huge projections that gold could absolutely surge, maybe even running all the way up towards $3,700 an ounce. It just shows you how split the experts are on where to find safety right now.
Now, for those who really believe in the gold story, especially the technical analysts, they are laser-focused on one critical number, and that number is $3,500. This is seen as a major resistance level, like a ceiling that's been holding the price down.
And the technical idea here is actually pretty simple. If gold can finally and decisively smash through that $3,500 ceiling, the theory is it won't just slowly grind higher. No, it could trigger a really sharp, significant rally, with a lot of analysts thinking we could see a quick jump into the $4,000 to $4,500 range.
And listen, this isn't just about lines on a chart. There are strong fundamental reasons supporting gold too. The market still believes rate cuts have to happen eventually, even if they're delayed. And maybe most importantly, central banks all over the world are buying up gold at a historic pace. They're using it as a hedge, and that creates a really solid floor under the price.
Okay, so let's wrap this all up with our key takeaways. With these two powerful competing stories playing out, how should you even think about these markets?
It really all boils down to this central conflict. U.S. stocks are running on pure hope, risking a bubble bursting if the Fed lets the market down. Gold, on the other hand, is actually being supported by the exact same uncertainty that's threatening stocks. You can see the divide perfectly right here in the big bank calls. Bank of America is cautious on stocks, while UBS is super bullish on gold. It's two completely opposite takes on the exact same set of facts.
And that really leaves us with one critical question, doesn't it?
When the entire market is moving not based on what is, but on what might be. The biggest challenge for any investor is figuring out which story you believe. How do you separate the real signal from all the noise?
Thanks so much for joining our channel for this explainer. If you found it helpful, we'd really appreciate it if you'd subscribe and like. We'll see you in the next one.